And silver tested when it broke out of the cup and handle, came down and tested it, and now has gone back up. That's big technical-wise. Gold looks very strong again. And I would argue that a lot of people that sold came in during silver squeeze. This created the distortions, that along with the ETFs rebalancing and the 300% increase in margins. Will it be the bond market? Will it be the stock market? Will it be a crack? It's one of these deals where there is yield curve control happening already. And whether they want to admit it or not, they're capping the back end of the bond market surreptitiously. And when they do that, and yields are not allowed to rise, which is the release valve of inflation, the middle class and the poor get eviscerated as the cost of living goes much higher. And we've yet to even see these oil-induced inflationary effects. Typically, they're 4 to 6 months out. When you see what oil is doing and the cost of the war and the amount of inflation, we're spending roughly $15 billion a day in debt just since July 1st. But I think this time those that wanted to sell have sold. Those who tried to sell and were upset by the premiums, I get it. I've never seen it in 36 years.
Can you talk to us about both in the metals themselves and perhaps the miners, what you've been watching and what you've been hearing about from those that you connect with in conferences you've been attending?
I mean, let's just take the central banks out of the equation, who are buying more than ever. Same with China. You look at Tether, they're up to 20 billion, but they bought another 4 billion just the other day, over the last 4 weeks, I should say. They had 3-4 billion. They're buying more. Let's take all of them out of the equation. And I'll answer this in a way that that I probably wouldn't answer it this way, but I'll answer it in a way maybe the mainstream would answer it. And forget about the central banks, forget about the commercial banks, forget about all the deliveries. I think that the sophisticated trader, the big money, smart hedge fund, JP Morgan, these guys are, I think they realize the irony of the market, that the broader and higher these markets go, the harder it becomes for the policymakers to ever meaningfully remove the liquidity supporting them without breaking something. And when you see M2 going to the moon right now, that's exactly what I mean. When you see intervention to keep Japan from selling treasuries, that is what I mean. When you see supposedly this little country in the Cayman Islands owning as many treasuries as they do, this is what I mean. And again, I want people to, for a moment, realize that it's not just treasuries that would be affected if Japan sold treasuries. It's not the treasury market.
If liquidity keeps rising while policymakers pretend to normalize, savers could be trapped inside an asset price illusion. Andy Schectman notes that M2 expansion and intervention around Japan reveal how dependent markets have become on monetary support. Removing liquidity now risks breaking bonds, equities, or currencies simultaneously. That makes gold less speculative and more insurance against policy constraints. Next, Andy Schectman exposes why the treasury market may not be the only market policymakers fear.
This carry trade has propped up the equity market as well. And I think that what you are seeing is the realization that the answer to every problem eventually becomes more liquidity, more debt, more currency creation. I think it's safe to say the era of aggressively shrinking the Fed's balance sheet appears to be over for now. What happened to quantitative tightening? And now they're adding 40 plus billion a month. They don't call it QE, but that's exactly what it is. And bailing out Japan wasn't bailing out Japan. It's yield curve control. Call it what it is. And I think long-term, the debt is not sustainable. It's that simple. And I think markets are beginning to understand that. And what that would mean in a free market is that these markets would push interest rates higher. At that point, our indebtedness becomes even less sustainable, forcing the Fed to cap rates. And that's where we're at. And a rate that can no longer rise fuels inflation as a release valve. That means that real rates fall or even turn negative. And I think the market is beginning to realize that. And so you have sophisticated traders, if I were guessing, like really smart technical traders that are front-running gold, because I think they understand that through all of this, you have a Fed that is trying to redefine what inflation is. And if they change how inflation is measured, they can make the numbers appear closer to their 2% target, which they haven't hit in over 65 months, creating this political and financial cover for more rate cuts and more liquidity and more printing and more buying, or the holding blows up.
The Fed can call it tightening, but if its balance sheet expands, the label matters less than the cash reaching markets. According to Andy Schectman, adding more than $40 billion monthly while fighting inflation signals a policy contradiction investors should not ignore. If rates cannot rise without destabilizing debt, negative real returns become the pressure valve. That favors hard assets over cash. Next, Andy Schectman reveals how changing inflation measurement could justify even more liquidity.
And I think they understand this, and they can make inflation look better on paper while everyone's purchasing power continues to get worse in reality. And again, I've said it in other ways. You know, you measure things in dollars, they're getting more expensive. Measure it in gold, they're deflating. And that's the moral of the story is inflation ain't going anywhere. Peter Schiff was right when he said that. When everyone was talking rate hikes and slowing the economy, he said it ain't going to happen, and it's going to be more and more and more inflation. And he's right. It ain't going anywhere. And, I think in other words, we're going to sacrifice our purchasing power to preserve the government's power more than anything. So, I think that's the most important thing to me.
For years, guests on our channel have talked about what you just described as gold sniffing out in advance the direction that the monetary system is heading. So you touched on that. What does that portend for the ongoing support under this current floor that gold and silver seem to have found?
Oh, I just think that it's showing you that gold and silver have sniffed it out. They're sniffing out the real yields, and the big money understands that. Normally when you see the kind of gains that we saw Friday, you would expect a big sell-off on Monday. Didn't happen. It's holding very tight. It seems to have shook out all of the speculation, all of the open interest. No one even notices that gold and silver are coming back up. No one even notices that silver's back to 65 and gold's at 4,400.
The dangerous part of inflation is not higher prices alone, but losing purchasing power while official numbers look reassuring. What Andy Schectman is highlighting is gold's ability to signal weakening real yields before that deterioration becomes obvious elsewhere. If metals hold after speculative positioning is washed out, that suggests underlying demand rather than temporary excitement. For long-term savers, that distinction matters enormously. Next, Andy Schectman reveals why quiet strength after a correction may be the real institutional signal.
It's meaningful, and corrections are necessary. It got overextended. It brought in too much froth, too much speculation. But we are beginning to see that it is quietly resuming its march higher in an environment where all the speculation is gone. They've brought their toys to a different sandbox. They're speculating in AI or whatever the hell they're doing. They're certainly not in the metals market. And the most important thing for me through all of this 6 months of difficult market action is that the central banks have bought more than ever. And look at China, right? I'm just going to read some of their purchases that they've told us about. JP Morgan or Goldman Sachs says, no, they're underestimating by like a factor of 4.5. But here are their purchases that they've declared in gold. 40,000 ounces in January, 30,000 in February, 160,000 in March, 260,000 in April, 320,000 in May, 80,000 in June, and 640,000 in July. That's what they're telling us, right? So, what is 640,000 times, call it 4,400? I don't even know if my calculator will go that high. 281,600,000, maybe that's what it is. But that's what they bought in June. So they're buying so much gold every single month as the price is doing nothing. You look at the central banks, the largest first quarter ever. The second quarter is coming in super strong as well. You look at all of the central bank buying. They said it was the most they ever bought and lied about it by a factor of 15, 244 metric tons.
Gold does not need another speculative frenzy if central banks are accumulating while retail attention moves elsewhere. According to Andy Schectman, declared purchases rose from 40,000 ounces in January to 640,000 in July, a 16-fold jump. The bigger signal is that buying accelerated despite price weakness, suggesting institutions view corrections as accumulation windows. Investors should watch ownership behavior, not headlines. Next, Andy Schectman exposes why reported central bank demand may dramatically understate the real accumulation.
And when you talk about a metric ton, that's 244 times 32,150. That's 7,844,600 ounces of gold that was bought in the first quarter that we know of by the central banks. Call it times 4,000 even, and you're at 31,378,000,000 that the central banks have bought in the first quarter that we know of. The Bank of Korea resuming physical gold purchases for the first time in 13 years. And you get to Tether and you wonder, why is Tether buying so much gold? And, where is it all going? I've told you my thesis on that before, but, here it is again. And, they're buying more gold than anyone in the world, even more than China, except the Central Bank of Poland. And, it's crazy what's happening right now in terms of gold and silver accumulation as the price is getting beat up. I think that's really the most important thing to understand is that, over the last 4 weeks, Tether has bought 701,000 ounces of gold. And what is that? That's almost $3 billion over the last 4 weeks. I mean, this is a crypto company buying gold. These are central banks who print money buying the one thing they can't print. Gold. The biggest money who understands the system is using the drawdown in price, the drawdown in open interest, the drawdown in any recognition. And after all of the carnage there, they're using it as a tool to buy it on the cheap and without people noticing.
The strongest accumulation signal may appear when prices look weakest and mainstream attention disappears. Tether's reported 701,000 ounce gold purchase over 4 weeks alongside central bank accumulation suggests major buyers are treating weakness as opportunity. This is where Andy Schectman's thesis shifts from price prediction to behavior. Institutions are securing scarce assets while retail debates whether the correction is over. Next, Andy Schectman reveals the hidden positioning advantage created when everyone else mistakes accumulation for weakness.
In the face of all of this, for those who have been stacking for some time and are looking for an entry point, they certainly were some rattled by the extraordinary run-up that happened in fourth quarter and beginning of the year here in January, but wondering if this is a reasonable time to do getting a toe back in the water. It was interesting, the post we saw from Tavi Costa saying that, and frankly also Middlecamp saying that the 50% pullback is what major bull market pullbacks are made of, and maybe that there's maybe a 10 to 20% downside risk and a 100 to 200% upside, similar probabilities. So this is at the times that people who add value typically do so.
Richard Russell used to say the same thing all the time, that Dow theory would say it goes up, a whole bunch comes back 50%, shakes everyone off the bull, and then resumes. And so that's true. And we've seen it. It certainly shook everyone off. And I would also argue that the people that sold on the retail side sold for this, they're out, and they were holding it for different reasons. They sold the whole way up. I think the people that understand it aren't selling right now and have strong grips. I think you'll see the premiums in the marketplace really normalize this time up, because I think you'll get a subsection of the public interested in metals that haven't been in it before.
The best entry points rarely arrive when investors feel comfortable, because discomfort is what clears crowded trades. Tavi Costa's 50% pullback framework implies that a deep correction can reset positioning without destroying the larger trend. The crucial shift is retail capitulation. Weak hands may have already exited, leaving stronger ownership behind. This changes the risk profile for patient investors. Next, Andy Schectman reveals why normalized premiums could signal a new wave of demand rather than weakness.
And I would argue that a lot of people that sold came in during silver squeeze, held it for the wrong reasons, got really upset that they bought it at 30 and it fell all the way down to 18 or whatever, and finally got back up and then rode it up and sold the whole way up once it got past 50. This created the distortions, that along with the ETFs rebalancing and the 300% increase in margins, which we've talked about, along with the right in January where all the distributors had to take in the 2026 allocations. So you had allocations that require hundreds of millions of dollars to be spent across the main distributors, the public selling, the price getting killed, margin rates going up 300% was a perfect storm. That's what created the screw up in all of the premiums on this, on the bid side and the ask side, where you were buying junk silver way below spot and getting way below spot when you were selling just about anything. That's going to change. And I think you'll see it. It may not get to where it was during Silicon and Signature, where we were paying $9 over spot for junk silver from the public and $12 over for Silver Eagles. Maybe it will. Maybe we'll get close to that. But just like that was an outlier, so too is what we've seen the last few months. I think the public will start to get interested this time. And what will it be? Will it be the bond market? Will it be the stock market? Will it be a crack, via the carry trade? Who knows what it is?
A 300% margin increase can create a price collapse that looks fundamentally bearish even when physical demand has not disappeared. What Andy Schectman is highlighting is how forced selling, ETF rebalancing, and distributor obligations can distort premiums simultaneously. That matters because distressed pricing can fool investors into confusing market mechanics with genuine demand destruction. The next shock could reverse that distortion quickly. Next, Andy Schectman unravels what happens when forced sellers disappear, but physical buyers remain.
But I think this time those that wanted to sell have sold, and they sold into a perfect storm. So those who tried to sell and were upset by the premiums, I get it. I've never seen it in 36 years, and I think it will be different this time as metal moves higher. We've shooken off everyone that wasn't in it for the right reasons, ultimately. Doesn't mean, maybe that's not fair. Those that were holding it and didn't want to hold it for the long term, they sold. And I think that certainly removed a lot of that potential selling pressure on the retail side on this next leg up, which we might be at the beginning of right now, as it came down and silver tested when it broke out of the cup and handle, came down and tested it, and now has gone back up. That's big technical wise. Gold looks very strong again. So if you're not sure, cost average, start buying a little bit at a time, and that will smooth out the uncertainty, because of course we live in a world where logic and outcome sometimes are disconnected. Ultimately, mathematics will win, but short term, there could still be more volatility. And Tavi is right with the 50%. That is exactly what Richard always used to say. So we didn't quite get to 50 in gold, so maybe there is a little downside, but to his point, the upside might be more attractive than the potential downside.
Silver's rebound becomes more interesting when the investors most eager to sell may already be gone. Andy Schectman's framework suggests corrections can reset positioning before the next trend develops, while the cup and handle retest adds technical confirmation. The key question is not whether volatility returns, but whether sellers have enough inventory left to overwhelm renewed demand. For wealth preservation, gradual accumulation can reduce timing risk. Next, Andy Schectman reveals the contradiction between falling prices and strengthening underlying ownership.
And so it's one of these deals where, there is yield curve control happening already. And whether they want to admit it or not, they're capping the back end of the bond market surreptitiously. And when they do that and yields are not allowed to rise, which is the release valve of inflation, it has to find its way out, and it will find its way out in the form of price inflation. And we will see that. And this brings us to the Cantillon effect, which says those closest to the money benefit disproportionately. In other words, a lot of that money that's being look at M2, it's going through the roof. And that is the real definition of inflation. They want to redefine inflation, get it closer to 2.5. In other words, lie about it some more. But the real inflation is happening through the increase in the money supply. It's just manifesting itself in like the S&P, where 72% of the S&P stocks are now trading above their 200-day moving average. It's the strongest market we've seen in a while. If you were just looking at the S&P, you would think everything is fine. In other words, the things that the money is going into has not measured supposedly by the CPI. And so when that money finally trickles down to the economy, it's in the form of much higher prices, especially as things get sold off, as money is sold and then goes into the economy. It will manifest in much higher prices to the people who can't afford that the most. The wealthy get wealthier as their assets go higher.
A market can look healthy precisely because monetary distortion is masking the inflation underneath it. This is where Andy Schectman's thesis shifts toward the Cantillon effect. Expanding money supply benefits asset owners first, while everyday purchasing power deteriorates later. With 72% of S&P stocks above the 200-day average, investors may mistake liquidity for economic strength. That distinction matters for anyone holding cash. Next, Andy Schectman exposes why the inflation bill may still be ahead.
And the middle class and the poor get eviscerated as the cost of living goes much higher, and we've yet to even see these oil-induced inflationary effects. Typically, they're 4 to 6 months out. Well, when you see what oil is doing and the cost of the war and the amount of inflation, we're spending roughly $15 billion a day in debt just since July 1st. The amount of debt that is increasing is off the charts. And so inflation is not going anywhere. And so normally that would mean higher bond yields. But if the yields go up, we know what happens. And so this is one of those tightrope dancing deals that I think it's kind of scary to think how it ultimately plays out. But certainly to be cautious right now in your financial affairs is not a bad idea.
The real danger is an inflation shock, arriving after investors have already positioned for stability. Andy Schectman notes that oil-related inflation can take months to feed through the economy, while roughly $15 billion a day in additional debt intensifies the underlying pressure. If yields cannot rise without destabilizing heavily indebted markets, policymakers face an ugly choice between inflation and financial stress.